In this video, we're going to talk about how to balance between the SEP IRA and the Roth IRA. How much do you put in each to reduce your taxes and maximize your retirement savings? But before we do, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner, helping you reach your financial goals. So balancing between the SEP IRA and the Roth IRA. This is actually a question that came from Al, and he said that as an independent contractor, I'm looking at ways to mix the right combination of contributions using my SEP IRA, Roth, and traditional. Now, if you have questions about your retirement planning or anything financial planning related, go ahead and leave them in the comments down below and I'll answer them on future videos. And Al, we will also throw in the traditional IRA in answering this question. Now, to start, we need to understand the contributions to the SEP IRA versus the Roth IRA. So with the SEP IRA, it goes in pre-tax. So it's reducing your taxable income today. It's growing tax deferred, but then in retirement, when you pull the money out of the SEP IRA, it's going to come out as ordinary income. Now on the Roth side, this is after tax. So it's like you got your paycheck, you paid your taxes. This is money that's in your bank account. Now you're going to put it into the Roth IRA, which are after tax dollars. Now those dollars are going to grow, and that growth will come out of the Roth IRA in retirement tax-free. So on one instance, we have the SEP IRA with pre-tax dollars, and on the other, we have the Roth IRA with after-tax dollars. So the first thing is, from an investment perspective, it doesn't matter which account you choose, just as long as you're in the same tax bracket today as you will be in the future. And this is where most people get it wrong, where they look at the Roth IRA and say, this is going to give me tax-free growth. I want to choose the Roth IRA because I'm not going to pay taxes on any of that growth. And what if my investments do really well? Well, you can have those same investments in the Roth IRA as you could in the SEP IRA. It's just a difference of how they're taxed. Now, there are other differences to the actual plans, but just from an investment standpoint, it doesn't matter which account you choose. So to illustrate this, we'll use $1 that's going into both types of accounts just to show you what the difference is. So if we put in $1 into our SEP IRA, we'll start with this SEP. 100% is going to go into that SEP IRA because it's going in pre-tax. Now, let's just say that investment doubles to $2. In retirement, if we're in the 20% tax bracket, that means that 20% of $2 is 40 cents. So that means we're going to have $1.60 that comes out. Now, on the other side, if we look at the Roth IRA with $1, it's going to be after tax money. So if we're in that same 20% tax bracket, that is going to be 80 cents. Well, if that same 80 cents doubles, it's $1.60. And because it's the Roth IRA in retirement, it's going to come out tax-free at $1.60. Now, even if we take these investments over a much longer time frame, we're still going to have the same results. So let's throw it on the financial calculator just to illustrate it. So if we have a 30-year investment at an 8% rate of return, and we're going to start with the SEP IRA. So we're going to put that $1, we'll make it $100 for this example. $100, and in 30 years from now, that's going to be $1,094. Now, if we take that $1,094 and we multiply that by 0.8, so we're getting 80%, assuming that we're in the 20% tax bracket, that brings us to a total of $870, and we can round that to $875. Now, if we put it into the Roth IRA, that's going to be after tax dollars. So our same $100 will now be $80. And we're going to do the same 30 years, the same 8% rate of return. That's going to give us the same amount of $875. So if it's the same investment, the same returns, it's going to have the same results, whether or not you choose the Roth IRA or the SEP IRA. So then the next thing I would take a look at would be your current tax bracket. So if we look at the tax brackets here, these are the 2020 tax brackets. And the idea is to get into the next lowest tax bracket by putting the money into the SEP IRA. So if you're married filing jointly, we can go to the second column right here. And we could see that at the 22% tax bracket, it starts at $80,251. So if you're right above that threshold, putting money into that will bump you into the 12% tax bracket. So then the maximum amount, you're basically getting the best bang for your buck by putting money into the SEP IRA to bump you into that lower tax bracket. But that's not always going to work. And the reason is, let's say that this was a really low tax year for you and you were in the 22% tax bracket in that same scenario. But in other years, you were in, say, the 35 or 37% tax bracket. So a normal year at 35 or 37% tax bracket, maybe it would make more sense to put more money into the Roth IRA. But that wouldn't be the only thing that I would take a look at if I was trying to figure out how much to put into the SEP IRA versus the Roth IRA. What I would also look at are credits and deductions. So in that instance, I would look to the credits that you might be able to qualify for. An easy one that we can talk about is the stimulus checks. So if you're right above, say, $150,000 married filing jointly, then putting some more money into the SEP IRA, you'd be able to maximize the amount of stimulus check money that you'd qualify for. And for those small business owners that are on the healthcare.gov health plans, you might qualify for additional subsidies or reduced plans by having a lower adjusted gross income. And going to the Roth IRA versus the traditional IRA, those two plans will aggregate. So the maximum that you can put into the Roth and the traditional IRA together is going to be $6,000 for 2020. And if for some reason that you wanted to put more money into the traditional side, say the SEP IRA, then you might want to take a look at a different plan if you're maxing it out. Then you might want to consider a solo 401k, which would allow you to put more money into the plan at lower earned income. Because the SEP IRA is only employer funded. So you can only put in the maximum of approximately 20% of your income into the SEP IRA. Where the solo 401k, you could basically do the same thing, but in addition to that, you can also do an additional $19,500. And you can also do a Roth side to the 401k, which could also help you get more Roth dollars in there as well. With the recent changes in the Secure Act of 2019 that changed the solo 401k's options to be open all the way up until the tax filing deadline, moving forward, I think a lot of small businesses will start to adopt a solo 401k over the SEP IRA. And one last point about having a retirement plan with multiple businesses. You're going to need to aggregate them in order to open up the plan, because most likely if you own multiple businesses, they're under the same ownership, which falls under controlled group rules, meaning that you're just going to net out the earned income of both companies if you're contributing into a retirement plan such as a SEP IRA. And that is how you balance between the SEP IRA and a Roth IRA. If you enjoyed this video, be sure to subscribe and leave your comments down at the bottom.